There are a few ways to bring down prices in an economy. A good place to start is not massively expanding the money supply in the first place, which is really the root cause of price inflation. But aside from that, one thing you can do is you can increase productivity, expanding the supply of goods and services available to consumers and thus driving prices lower. Another option is you can destroy demand. Basically, make everyone poorer so that they can't continue bidding up the price of goods and services. And unfortunately, that's the method that the Fed is currently pursuing. Hey everybody, Smart Silver Stacker here. Thanks for tuning into today's video. If you enjoy it, please do give it a big thumbs up down below. And today's video is brought to you by Silver Botanicals, awesome personal care products powered by Nano Silver. Check them out with the link down in the description, and don't forget to use coupon code STACKER to save 10% on your order. So look, hiking rates, it doesn't do anything to increase productivity in the economy. It does, however, create a reverse wealth effect of sorts as the price of assets owned by consumers fall and interest rates on record high levels of consumer debt go up. And the real problem here is that the much touted economic recovery that we've had since 2008, the one we've heard so much about from presidents on both sides of the aisle and from central bank chairmen and chairwomen alike, has been based on nothing but the Federal Reserve creating massive monetary expansion, aka the old, and if you ask me, correct definition of inflation. And if you don't think that the Federal Reserve is all that has been driving markets, the situation persists today. Just look at what's happening in today's trading session if you want some proof. Yesterday, we had Fed Governor Christopher Waller send stock futures to the red with some fairly hawkish rhetoric. He said, "We're at a point we can start thinking of maybe going to a slower pace, but we're not softening. Quit paying attention to the pace and start paying attention to where the end point is going to be. Until we get inflation down, that end point is still a ways out there." The 7.7% annualized increase in inflation recorded in October is still enormous, he said. And he pointed out, even if the Fed does scale back from the 3/4 point increases to a half-point increase at its next meeting, the rates are still moving higher. He also said, "We're going to need to see a continued run of this kind of behavior and inflation slowly starting to come down before we really start thinking about taking our foot off the brakes," adding that he has been further convinced the Fed is on the right path because the rate increases so far have not broken anything. Well, to that, I just want to point out that they haven't broken anything yet, but that is likely coming. And markets did not like this rhetoric from Waller. Futures were in the red, and at market open today, there was some pain. But then, surprise, surprise, today, Fed Vice Chair Lael Brainard gets floated out with a bit more of a dovish message. In a live Bloomberg interview, she said, "I think it will probably be appropriate soon to move to a slower pace of rate increases. I think what's really important to emphasize is we've done a lot, but we have additional work to do both on raising rates and sustaining restraint to bring inflation down to 2% over time. We have raised rates very rapidly, and we've been reducing the balance sheet, and you can see that in financial conditions. You can see that in inflation expectations, which are quite well anchored." And markets liked what she had to say a lot. She wasn't talking about 7.7% inflation still being enormous. She's focusing on a slower pace of rate hikes. And after that interview, well, now all the major stock indexes are in the green. And silver too, by the way. Despite starting off the day in the red, it's got a nice bid now, up over $22. And Brainard mentioned the Fed balance sheet, how it's been shrinking. Let's take a look. You can see that the balance sheet did peak earlier this year, and yeah, they've shrunk it a little by just under $300 billion. But that doesn't seem like too much when you realize that there's still $8.7 trillion to go. And what we're looking at here, this is the foundation of the whole economic recovery that we've had since 2008. If the Fed hadn't bought up almost $9 trillion worth of assets and kept interest rates near historic lows for more than a decade, there would have been no economic recovery. And if you think inflation from all of this is a new phenomenon, it's not. It's just that all of the inflation we experienced in asset prices since 2008 is now turning into inflation in consumer products like food and fuel. And so now everyone pays attention to it. And the only way that the Fed can fight inflation with their policies of rate hikes and quantitative tightening, shrinking the balance sheet, is by undoing that economic recovery, aka make everyone poorer. Now, will they be as committed to that policy as Governor Waller wants everyone to believe? Highly doubtful, because when something does finally break and the economic pain among voters becomes unbearable, there will be tremendous pressure on the Fed from politicians to make everything right with more unlimited easy money. And that's probably how this whole thing will play out in the long run. But before that happens, the pain might have to get pretty extreme. The Fed is likely aware that a major pivot and a return to easy money could seriously erode the purchasing power of the dollar and threaten its role as the world's sole reserve currency. And so, before they make such a move, they need to make sure everyone is begging and pleading with them to do so that they can say, oh, what choice did we have? The reality is that in order to fight this inflation problem successfully, we need a growing economy, more production, and more goods and services. But we won't get that until our leaders and central bankers stop trying to manage every aspect of the economy and let the free market do its job. You can't pay people to not work, you can't prop up zombie companies with taxpayer money, and you can't endlessly finance out-of-control government spending with the printing press and then expect to control inflation by twiddling with interest rates. It just won't work. All it's going to do is make the average person's economic situation much more tenuous. So, what can we expect moving forward? Well, to the extent that the Fed's fight against inflation is successful in the near term, it means economic pain, aka demand destruction for your average American. So get ready to tighten your belts, and ultimately, the real causes of inflation, they're not being addressed here. So ultimately, this fight is doomed. When the Fed does pivot in earnest, and I don't mean a slowdown in rate hikes, I mean when something really breaks and the floodgates of liquidity get reopened, well, expect inflation to get a lot worse. That's why I think now is a good time to be stacking hard assets, gold and silver, real inflation hedges. Also, getting out of debt, learning some new skills, starting a side hustle, whatever you can do to get ahead now. It's going to be very important later when times get a lot tougher. Now, none of this is financial advice. I'm just a guy on YouTube who likes silver coins and bars, so, look into these things for yourself. Do your own due diligence. But most of all, get prepared. Let me know what you think in the comments down below. Thanks for watching, everyone. Stay safe and happy stacking. Smart Silver Stacker, out.